Hi, I'm Mike Sintolo, editor of Cabot Market Letter and Cabot Top 10 Report, and I'm here with your Cabot Weekly Review. Well, the market's really been cheesed here the last week and a half, so I wanted to spend a good amount of time talking about market timing, and specifically trend following and why we think it's the best way to time the market. Then I want to get into building a watch list, and while there's not too many good-looking charts out there right now, I want to give you a couple of tactics to find, the stocks that really are holding up the best, subtle signs of relative strength. But first, let's take a look here at the Nasdaq Composite. The big benefit of trend following is, while you're never going to sell at the top here or buy at the bottom, the big benefit is you're always going to be in every major up move, every sustained up move, and you're always going to be out of, or at least mostly defensive for, any sustained down move. Now, the tough part is you have to leave your ego at the door. As I clean up the chart here, back here in January and February, I was doing videos, talking down here, and we had no idea if the market was just going to keep doing this, if it was going to go sideways, if it was going to start to rally like it did. You just sit there and say, at this point in time, it's negative, therefore I have to be defensive. Okay, it had broken below this black line, the 50-day moving average. That's your sign to get defensive and just wait for a turn for the most part. Well, as it turned out, we did get a turn here in late February, early March, and of course that was the beginning of a great run. We made great money in March and first half of April. But then again, you see this big breakdown here in early May, which was a sell signal, and we have not had a buy signal yet. Now, again, the tough part is you get run in a few times. I tell you right now, a week and a half ago, it was hard to, a lot of stocks looked good that we were following. The market was rallying. It was above this red line, the 25-day moving average. It looked like the 25-day moving average might start turning up in the days ahead. So it was hard to stay relatively defensive then, but we did, and of course, you see the result. Now, on the flip side, while it's hard to stay defensive when things look good, you also shouldn't get too negative when things look bad. I mean, right now it's all about double dip recession and possible bear market and this and that. Just ignore that stuff. Maybe yesterday was the bottom. Maybe that was the bottom of this entire correction, and we're just going to go up from here. Maybe we go down for another 2 or 3 months. Nobody knows. So the tough part is really putting your ego aside, just taking it day by day, and just accepting the fact that you don't know, and you don't, you're not trying to predict the future. You're just taking it day by day, step by step. Okay, but we do think trend following is the best method for the main reason that while there are some whipsaws every now and again, just being in all the major up moves and being mostly out of the major down moves puts you ahead of 90% of all investors. Okay, moving on to the watch list, let's look at Apple. And the reason I pull up this chart is, the market's had now 4 big dips. This was the flash crash right here where the Apple fell as low as 200. But then it had another correction here. It had another dip there. Then we had this run-in rally I was just referring to, and now we've had this last week or two of kind of meltdown. But notice how Apple's kind of had 3 higher lows since the flash crash. Now maybe it continues to break down, but I'm just saying at this point in time, it's had some higher lows. Aruba Networks, ARUN. Okay, this is even more dramatic here. Note how every time the market sells off, the stock does get hit, but then as soon as the market bounces for a few days or a couple of weeks, this stock is moving up to new recent peaks. Okay, that's a good sign. Acme Packet, APKT. Okay, this is actually still above the 50-day, and again, you see some higher lows here. So, if you're looking at charts, looking at a few dozen charts, that's one way to differentiate between some of the weaker ones and some of the stronger ones, are 2 or 3 higher lows in the last month or two. Okay, another thing you want to look for, and granted this is hard to find these days, but keep your eye open for tightness. This is ROVI, ROVI. Now the stock's been up and down here again as the market's had some big moves, but just notice how it's been pretty centered on 37, 38, and even right here, I know it's kind of hard to see, but the stock really hasn't pulled back much. It's actually gone up the last few days. It's right in this range. It's a sign of institutional accumulation when a stock can hold up that well and has a good growth story. This isn't tobacco or canned soup. This is a real growth story, yet the stock is holding up well. That's a good sign. And the third thing to look for, it's a little trickier. This is Green Mountain Coffee, is maybe some stocks that have great stories that really broke down during, say, on earnings in April or early May, but then resisted pretty well during May and early June. It hung in there. It hit a little bit of a new low here, but it didn't really, get cheesed. It had this rally, and just notice this, the stock is 12 weeks into a base. Now on this decline in the market, which is hitting new lows, Green Mountain is well above its old low. It's coming in a little bit. Now, there's a lot of work to do. This isn't nearly as high on your watch list as something like an Apple or an Aruba Networks that's in great position. But having two or three of these near the bottom of the list saying, hey, we're 3 months into a base building process. Maybe it takes another month or two or three, who knows? Okay, maybe it just breaks down. But if all goes well and the market holds in there, maybe Green Mountain pops up here and comes down and pops it and continues to build its base and eventually breaks out. So it is worth keeping an eye on some of these stocks, even though they're a little bit weaker than what we would normally look at, because in this market, let's face it, there's not too many great looking charts. That's why the market's down 17% from its high. So some of these base building stocks are worth keeping an eye on. That's all the time I have for today. Have a terrific 4th of July and come by again next week for another Cabot Weekly Review.